Since our last conversation, global markets have stayed volatile. Equities recovered from their early August correction, but took another dip in early September. There are several reasons why markets may remain volatile for the rest of the year. We are in a more seasonally challenged period with increasing political risks and mixed economic data. The Fed's interest rate decisions will likely heighten uncertainty. One of the most widely anticipated, yet hardest to predict US rate cuts finally took place at its September meeting. The Fed went big with a 50 basis point cut to support the economy, especially the cooling labour market. The move was preemptive as the Fed cautioned against assuming this magnitude sets the pace for future policy moves. The dot plot points to further cuts this year through 2026. Any further labour market weakness could bring more and faster cuts. As is often the case, a new cycle could portend changes in market dynamics. The rotation away from well-held mega-cap stocks that began in July has persisted. Investors continue to reallocate to previously overlooked areas such as utilities, consumer staples, non-US markets, and small to mid-cap stocks. This widening market breadth is partly driven by positive earnings growth in stocks outside the Magnificent Seven technology stocks. Conversations with regional clients suggest that expectations of the economy remain high, with soft landing still the base case scenario. Appetite for risk remains, and most clients are still overweight equities, though some have started paring back their exposure. Developed markets are still the consensus pick. In Asia, clients are turning more neutral towards China on economic concerns. Within fixed income, investors are still looking to lock in yields and add quality investment-grade bonds to portfolios. With the Fed having initiated the easing cycle, we expect further interest rate cuts over the next several months. So how should investors position their portfolios to benefit from a rate cut cycle? We think there are three areas worth highlighting. Firstly, high-quality investment-grade bonds. Investment-grade bonds tend to do well through an interest rate cut cycle. Besides that, their defensive nature also helps to diversify portfolios during crises and recessions. Investors can also consider quality global dividend stocks as we enter a rate cut cycle. These stocks are typically more resilient as the companies tend to operate in sectors that are less economically sensitive. They may stand to benefit if the ongoing market rotation away from the US and mega-cap stocks continue. Many of them tend to be listed outside of the US and often operate in overlooked sectors such as utilities and consumer staples. A third area to consider is small to mid-cap stocks. They tend to perform well when interest rates fall. Small-cap companies often rely on short-term borrowing, making lower interest rates beneficial for their bottom lines. We have also started to see an acceleration in earnings in the smaller companies at a time when large-cap companies are seeing slower profit growth. The valuation differential between small, mid-caps, and large caps remain at extreme levels, leaving room for the former to catch up.